Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in Accounting, and our topic today is capital stock. What is it? Obtaining capital by issuing stock in a corporation is called equity financing. A value assigned to a share of stock is called the par value or the legal value. The date on which a business issues a note, bond, or stock is called the issue date. How does it work? Let's see how common stocks work. So, guys, remember all our Excel files are free, and the link to download it is in our video description. So, okay. Transaction 1, issuing capital stock, February 25th. February 25th. Good. So, we are issuing, so we are receiving money, so debit cash on document receipt 16. How much? Let's see here. Sold 10,000 shares of $10 par value. So it is 10,000 shares times $10 par value. 100,000, 100,000. So no excess of par here. We sold it by the legal value or the par value. Debit, 100. Credit. What is our credit? Capital, stock, common stocks. Now, cash receipts, we are receiving money. So, the date, February 25th. Capital stock common. Credit, $100,000. No accounts receivable, no sales, only cash debit, $100,000. Now we are issuing additional stocks on August 4th. Again, debit cash. Receipt 8/11. So now we sold 600 shares, $10 par value, 6,000. However, we sold it at $40. So $30 is the additional paid in capital. It's our, under a lot of quotes here, our profit or our gain. But this gain is not on the income statement. It is also an equity account. How do we find it? 600 shares times 40, our price, less 10, that is our par value. 18, 6 plus 18, 24. So our cash, it is the sum of both here, 24. Now our credits, again, capital stock common stocks, 6. And a second credit here, paid in capital, excess of par common stocks. Let's too long here, so come on, Excel. Come on, don't freeze. Don't freeze yet. Wrap text. Whoa. Now we're good. And then the 18th. Our cash receipts here. August. Capital stock, common stocks. And then, so let's do something here. Yep, it will be pretty because the second one is the paid in capital. Format cells here, also wrap it. Okay. Oh, and here the document number. First one receipt 16. The second one receipt 811. Our credit for capital stock common 6. Paid in capital in excess of par for common stocks 18. And the cash debit in either of those rows here, the 24. So 124 for both. However, we have a second stock, call it preferred stock, and usually it is at par value. So it's a class of stock. What is the difference between common stock and preferred stocks? Preferred stock is a class of stock that gives preferred shareholders preference over common shareholders in dividends along with other rights. Okay, so we need to pay dividends. We don't have money to pay to all of our shareholders. We pay first to preferred stocks. However, they are non-voting stocks, so they cannot vote on any decision of the company. And it's typically described by referring to the stock's dividend rate and par value. So here, issued 400 shares of 6%. So it means that we will pay 6% a dividend per year. So 6% of the total amount. Preferred stocks at par value $20,000. How do we find the $20,000? 400 shares times $50 par value. So we will pay them every year 6% of $20,000 times 6%, $1,200 of dividends. So it is just like an interest here. What is our journal entry? August 16th, cash and capital stock. However, it's not common stock anymore. It is preferred stocks. Receipt 815. How much? 20 and 20. Debit, cash, credit, capital stock, preferred. And here the same, August 19th, common stock, preferred, receipt 815, on credit 20, and cash debit 20. So 144 for both credits and debits. So we're good. And here also 144 debits and credits. Okay, guys, so thank you so much. Questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.